Hello everyone, welcome to a presentation. This is my first sort of presentation like this, not about trading, but just about the economy, and I'm mainly going to talk about bonds. And recently I've been learning a lot about the economy, and I've sort of taken notes and made presentations with these notes, and I plan on doing more of these, but this is my first one on bonds. So this is a bond, as you can see on the screen there. It's a United States saving bond for $100. Okay, you can think of these like cash, except that it pays you to hold it. Right, so you can't just go to the store and buy stuff with it like you can with regular cash. It's a special type of cash that pays you a certain amount of money per period of time to hold on to it for a certain amount of time. So there's going to be 6 main topics I want to touch: definition and why, maturity, yield and price relationship, the market value, risks to bonds, and the inverted yield curve. Alright, so what is a bond? I have the actual definition from Investopedia on the screen there. You can read that. It's a very short definition. But I'm going to answer the why and the who. So they provide a predictable income stream. If the bonds are held to maturity, bondholders get back the entire principal, so bonds are a way to preserve capital while investing. So this principal, also known as face value or principal value, this is the initial bond worth. That's when it's issued to the person that buys the bond. Right? The issuer is the person that gives the bond. So we'll take the United States government as example. If the government gives the investor a bond, well, the investor is going to be able to get a return, but he initially that return is taken from this initial value. So if that initial value is $1,000, that means that the investor gave the government $1,000 and the government issued him a $1,000 bond. So the principal value is $1,000. Bonds can help offset exposure to more volatile holdings. Governments and corporations use bonds to finance various projects and operations, for example, roads, schools, infrastructure, and business expansion. So yeah, it's not just governments, there's also corporations that can have bonds and can give you bonds. Okay. And remember, once, it could be a 5-year bond, 20-year bond, even just 6-month bond. But once the term is up, you are able to get your initial investment back. The majority of the U.S. national debt is owned by Social Security, the Federal Reserve, and foreign investors. So there's trillions and trillions of dollars in the bond market. For example, Japan has 1.15 trillion US dollars in the bond market in just United States Treasury bonds. Okay, and really anyone can buy bonds. Anyone that, just me, you, anyone. You don't have to be a country or a bank or anything. So it's a very, very big market. Right, now bonds are like milk because they expire. So, like I said, there's a maturity, and this is the length of time it takes for bond issuers to repay the face value of the loan. All right, and now there's another type of value, and it's the market value, but we're going to talk about that later. It's important to note that the bond maturity is different than the duration. So I even got mixed up in this when I first started learning about bonds. I started to call the maturity the duration. All right, there is a difference between the two. Bond duration is a measure of a bond sensitivity to changes in interest rates. All right, so this has to do with the market value. The interest rates that I'm talking about are the Fed fund rates. That's the ones that the Federal Reserve set once every month when they have their FOMC meetings and the chairman does his decision, right? And they vote on what they should do next. And that influences not just the yields in bonds, but it influences in real estate, it influences in markets all across the world, and the stock market, every market. So even commodities, everything revolves around the Fed fund rates, the interest rates I'm talking about here. So yes, you can sell the bond on the market for more or less. More on that in another slide. So yeah, this is the market value. I'm going to talk about that. Most of the time, the longer the maturity, the bigger the coupon yield. And this makes sense because if you're giving somebody a bond for 30 years, you'd expect to be paid more. So the investor would be expected to pay more, right, as the issuer, than if you, as the issuer, or as the investor, bought a bond for 1 month, right? It's just a month, so it's understandable that you're gonna get paid a lot less, because it's just 1 month compared to 30 years. The loan duration is much different. All right, and here I say that bonds are like milk because they expire. So bonds have a maturity, and that is the length of time it takes for the bond issuer to repay the face value of the loan, regardless of what the market value is. And it's important to note that bond maturity is different than duration, and I did this mistake. I would call maturity duration sometimes, but there's actual bond duration is an actual thing. It has to do with its the market value, which I'll talk about a little bit in the next slide, I believe. But don't get the two mixed up. The bond duration is a measure of a bond's sensitivity to changes in interest rates. And yes, you can sell the bond on the market for more or less than what the face value was, but I'll talk about that in another slide. And most of the time, the longer the maturity, the bigger the coupon yield. And that makes sense because if you're taking out a loan for 30 years, you're going to expect to pay more in terms of your interest, right, than if you just taking out a loan for a month. Right? It's not going to be as the person who's issuing you the loan, who's giving you the money for that loan, who's holding the debt, well, he's going to expect a much smaller yield if you only need the money for a month. Anyways, I wanted to touch on interest rates. I wanted to just quickly touch on the interest rates. The interest rates, I'm talking about the federal fund rates, or the Fed fund rates. This makes every single market, commodities, stock market, real estate market, the bond market, all markets revolve around the interest rates. And the Fed fund rates is just what the Federal Reserve, once a month, they make their decision whether they want to raise it, lower it, do nothing. And they have these meetings, and Jerome Powell is the chairman right now, and he goes on and everyone listens to him talk. And yeah, so I have a couple of exercises down here. If you use the formula at the top right, this will just kind of get you to understand the yield to maturity. So basically, if you bought a bond at the face value of $1,000, so the PV is the value you paid, right? The paid value. Well, this would cancel out. It'd be zero. So your coupon would be the dollar amount of the payments. So if you had a 4% bond, your coupon, your annual coupon would be 4%, which means there's a 4% yield. Well, you would do 4% times the face value, which is, well, that would be $40. So your coupon, your payment, your dollar value of payments is $40 coupon, right? And then you have your face value plus paid value divided by 2. So basically that would just give you, if you're calculating from when you initially bought it, which would, if you haven't sold it, if the paid value is exactly what the face value is, then you're going to get that face value back plus all the coupons, and that's going to give you the yield, the percentage of return you're going to get on that bond in total, right? So you might want to use this because sometimes you might pay less, right? You might pay less for a bond, or you might pay more for a bond, and so it can affect that return on investment. Okay, often you're going to pay more, and you're going to really want to know then, okay, is this worth buying the bond? Like, how much is my ROI going to be, my return on investment? Is it better to put my money somewhere else? Basically is what you would use this formula for. Now, prices versus yield. Okay, the yield of a bond will never change once issued, but the market of an issued bond is based on what the spot yield is for those bonds. A spot yield is like, think of it as on the spot. What's the yield right now for new bonds, the new bonds that are printed, and based on what the current interest rates are. So what this means is that the market value of a bond and spot yields of that same bond are inversely correlated. All right, you can see that by this chart here. You have the relationship between bond prices and yields. Dark blue, you have bond prices. Light blue, you have bond yields. So when bond prices go down, you have the yields that go up generally, and vice versa. Okay, a $1,000 bond that expires in 20 years with a coupon of 5% may be more valuable if newly issued bonds have at 3% coupons, vice versa. Right, you can understand that if you bought a $1,000 bond and it's good for another 20 years and you get 5% on it every year, well, the newer bonds at 3%, a lot more people are going to want yours that are at 5%, so they're going to be willing to pay more than what the face value is, right, to obtain your bond. Yields are determined by Federal Reserve's monetary policy. So yeah, I mentioned that last one in the last slide. So what is the market value? Right, what determines a bond's price, right, based on what the interest rate is and all that, and the time it has till duration. See the sigma function on the right, this formula over here, will determine the market price of a bond. I would use a bond calculator if you really want to know, because this gets pretty complicated if you want to use big values. But this will give you an approximation of, or is it the yield? I think it's the yield to maturity that gives you an approximation. I'm not sure if this is an approximation or it's going to give you an exact value, but it's the market price, right? So it might not even be that. It depends. You need the counterparty liquidity for it. But remember that if you sell a bond before maturity, you probably won't get the face value, what you paid for in return. The main factors that price your bond will depend on the amount of years left until maturity, the coupon payments you get for holding the bond, and the face value. Remember that coupon payments are found by coupon rate times face value. Okay, so risks and impacts. Bonds are only as safe as the underlying issuer. So if you don't, what is the market value of a bond? So on the right here I have a formula for the bond pricing. It's a sigma function. I would just use a bond pricing calculator if you ever need to price the market value of a bond, which you probably won't need to do unless you buy a lot of bonds maybe, but anyone watching my videos, I don't know. But still, alright, what is a market value of a bond? So on the right here I have the bond pricing. It's a sigma function that determines the market value of a certain bond. You probably won't need to use this formula. In fact, you could just use a bond pricing calculator. It would just if you're able to put in all the values, it would be able to just calculate this for you. But just a couple of reminders. Remember that if you sell a bond for maturity, you probably won't get the face value, what you paid for in return. The main factors that price your bond will depend on the amount of years left until maturity, the coupon payments you get for holding the bond, and the face value. And remember that coupon payments are found by coupon rate times face value. And there may be a couple more factors too that are harder to understand, like what's going on in the economy and all that. Those are outside factors that can influence bonds, but we're just talking directly inside the bonds, what could be their worth. Okay, now this is where we get into the meat of things, what I really wanted to talk about, the risks and impacts of bonds. Right, so bonds are like cash, and you get paid for holding that cash. You think that it's very, very safe, especially if you're buying a government bond, but even government bonds still have their own risks. Right, but first, let's start out with how bonds are only as safe as the underlying issuer. So if you don't think the issuer will go bankrupt, then your money will be safe. Right, so the government, if you don't think the government is going to go bankrupt, well, then bonds are very, very safe. And it's true. I would say it's almost impossible the government will default on its debt and won't be able to pay you back for your bonds. There's always a chance, but still, we understand that that is very, very, very likely not to happen. Inflation is a risk. If the bond you're holding pays you less than the growth of inflation, you will lose money on your bond. And this will cause investors to sell it cheaper than face value and take a loss so they can reinvest in newer bonds. Right, so why would you want to hold a 30-year bond if you're losing to inflation? Your money is going to be tied up into something that's deteriorating your buying power, right? So you're going to want to get liquid. You're going to want to get out of that bond. And so that means you might have to sell it at a cheaper price, and take a loss on the face value, and then try and go into a different bond. And it's likely that if the inflation is high and making you lose money on those bonds, the interest rates went up anyway, and then to fight inflation, and so then you can profit from the higher higher yielding bonds to get back. All you're really doing is taking a small haircut to avoid losing buying power to inflation, and that's always something that you need to be ready for. So a big risk no one talks about is what happens when a bank is forced to sell bonds early at cheaper prices because too many depositors want their money out of the bank and doesn't have enough cash reserve to give it to them. If the economic conditions have pushed up interest rates and consumers are worried about the health of the economy, banks would be at risk like they were in early 2023. So this is a big one because I talked about the prices to yield relationship. If the yields go up, the market price for a bond will go down. Not as many people will want it. Now, if you go to a bank and you ask them to close your account, you have like $20,000 in your account, and they won't be able to give you the money on the spot. And if you ask to withdraw more than $5,000, they probably will turn you around and say no. Right? Try and go to the bank and ask them to take out $25,000. They'll say no. Because they don't have that money in the bank. If they do, they're keeping it for other customers, right? And this is because banks don't maybe keep like 10. I'd be surprised if they keep over 10% of the actual depositors' money in physical cash. Right? Most of the money that banks have don't actually exist, and that's for a different video because I can go on length on this topic. But basically, if the depositors want their money in cash because they don't feel safe with what's going on, they think the banks aren't sound, and they want their money in cash for whatever reason, they panic, and this is called a bank run. Well, the bank won't have the money to give it to them, right? And if their money is in bonds, because most of the time it is, and a lot of banks hold bonds because it's safe and it gives them a return, and if they have a bunch of depositors' money, they usually invest that money. And if they're into bonds, and what happens to the bond is that the prices, the interest rates go up and inflation goes up, the current bonds, which are paying lower yields, are cheaper, which their balance sheet, it's going to hurt them. It's going to show that they have less money on their balance sheet. And if the depositors want their cash back, well, they're going to have to take a big haircut on those bonds, and they might not have enough money to stay afloat, and they might have to declare bankruptcy. And that's exactly what happened to Silicon Valley Bank in 2023 and two other big banks in Silicon Valley. And it's what happened to Nations Bank. I think it was, a recent bank, First Republic Bank. I think it's a bank in New York that just failed last month. So this is all because the Federal Reserve had raised the interest rates up until early 2023 last year. And they had to stop raising them because it started a lot of bank failures, and they didn't want the bigger banks to fail. So another is not having liquidity to sell your bonds. This is very important because you might have asked yourself the question, okay, well, if I want to sell my bonds, and obviously they're shit because inflation's so high, am I just going to sell them for a higher price to someone who's going to lose off inflation anyway? Yeah, you will. Someone needs to buy those bonds. So for some bond types, it may take a couple days to liquidate your bond, but even some bonds may be worthless and no one will buy it. And this might be corporate bonds. If you're in, a corporation gives you a bond, it's worthless. It probably won't find a buyer. But in most cases, U.S. government bonds are liquid because the Federal Reserve has tools to provide liquidity for these bonds, right? And this is important. The Federal Reserve, they have the things they can use to absorb this liquidity onto their balance sheet. And that's why, if you want to sell the bond to the Federal Reserve, they'll be able to buy it at a high enough price that it doesn't really affect them too much with all the other tools they have. And they're the ones that buy most of the bonds. They provide most liquidity, the trillions of dollars of bonds that are getting sold all the time. But if for whatever reason something would cause the Federal Reserve to be incapable of buying back bonds while the market is panicking and mass selling bonds, and this would create a major liquidity crisis and trouble the consumer. And I'll think about why. I basically just explained it, right? If the prices of the bonds go up and the banks need to sell the bonds, they can't if the Federal Reserve is in a position where they can't buy back the bonds. Now, most of the time they will buy back the bonds, but sometimes they aren't. And why would this be a problem, right? What would happen? What would need to happen for that liquidity to come in, and like the right now it's happening. Um, all right, so why would this create a major liquidity crisis and trouble the consumer? Well, I basically kind of already explained it. Silicon Valley Bank, for example, if they couldn't have sold their bonds, they didn't have enough liquidity to sell their bonds, they would have needed to sell it for a very, very cheap price, so that, because the public can only offer up so much money. If they were to sell it on the open market to public, they can only sell it for so much money. And I would imagine that if they're selling to the public, not the Federal Reserve, they're going to be selling for a way, 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 way bigger haircut. And I mean, that would have been a lot of money gone. So it would create market crashes. It would create lots of panic, and it would create a major, major crisis. But right now, what is happening is that actually, as it turns out, the Federal Reserve is doing quantitative tightening. What quantitative tightening is just that they're reducing their balance sheet. So if buying back bonds is increasing your balance sheet, right now they're not buying back bonds. They're letting the open market doing all the buybacks. They're not doing it. Right now, they're not buying back bonds. They're doing quantitative tightening. They're reducing their balance sheet. They're selling assets, not buying them. And they're planning on doing it for the rest of the year. So what happens is, if in the case there's a big crisis and they need to buy back the bonds, the Treasury came in and said that they will use their TGA to buy back the bonds. The TGA is called the Treasury General Account. It's an account within the Federal Reserve that they can use to buy back or to do anything, to send stimulus checks, to send money anywhere. It's like their spending account, the government spending account, what they spend on. Right? If they send you checks in the mail for with money, it comes out of the TGA. So they're going to use. They said that they would use the TGA to support the market with liquidity if needed. If really the market needs to get out of so many bonds, they'll be there to get them out. But because they don't have the tools the Federal Reserve has, that could increase if there's a lot of selling, it could increase the what is it called, the national debt, the deficits, and it. So if the TGA is there to provide liquidity, and if the TGA is there, the only ones providing liquidity, and everyone is selling, this would be very, very bad, because they won't have the tools the Federal Reserve has to absorb that liquidity, and it's going to increase the national debt a lot. It's going to really hurt the country. But I think the fact that they're just saying that they're there to help is going to get people to stop worrying. And I think they might never even have to step in and do any work, but they're saying that just so that people can stop worrying. It would be a very bad thing, though, for the TGA to be the ones to provide liquidity instead of Federal Reserve. And that way the Federal Reserve can keep reducing their balance sheet at the expense of the national debt rising. But anyways, I think I covered everything there. And this is the yield curve. I took this chart myself. What I did is I took the 10-year yield and I did minus the 3-month yield. So it gave me a percentage difference of -1, which means that the 10-year yield pays you less than the 3-month yield. Now, this isn't normal. If you listen to the presentation and you took notes, your notes should say that for a longer term yield, you should be getting paid more than a shorter term yield. So why is this the case? Well, as you can see, this has been the case sometimes in the past, not often, but yeah, sometimes in the past. We have the 73 to 82 stagflation as a great example. This was when the country was straight up just shrinking, losing money. It was a very bad time. The Gulf War of 1990, right before it, the 2001 dot-com burst, the 2007 housing market crisis, 2020 COVID, and whatever is going to happen right now. Every time these yields revert and they get back above this red line, the crisis happens. Like the 2001 dot-com burst, the housing market crashes, COVID, Gulf War, and every time stagflation. I mean, this whole period was very, very bad. So it was pretty crazy, as you can see, very volatile. But I would expect right now we're calm. I would expect once we get back above the 0%, we revert. That's when stuff hits the fan, right? And I'll talk about this a little bit, but yield curve is a line that plots the yields or interest rates of bonds that have equal credit quality but different maturity dates. It's determined by taking the difference of yields from two bonds. So in the previous slide, I showed you the 10-year and 3-month, and I'll use these as an example. Notice how most of the time yield is above 0%. Now, you could throw this question out there, but let's just say you're ahead of COVID and you see these dropping beneath 0%. This happened a couple years before COVID actually came into effect. So you could have prepared yourself ahead of COVID. If you would have known that COVID is coming, you don't know when it's going to come. You just know that it will soon. You could have prepared yourself a couple of years ahead of COVID and moved money around so that, you're protected. And in case something does happen, something bad, you are protected and you're out of system, or your money's hedged somehow. If you're an investor, that's what I would do. Same thing with the 2007 housing market crisis, the 2001 dot-com burst, the Gulf War, and obviously stagflation. We had lots of periods in that time where, during the Civil War and after the World Wars, where it was really bad. But if you can think about why this happens, right, price and yield relationship. If in the short term investors are thinking that something bad's going to happen and that interest rates will have to go up because inflation goes up, it could be some sort of crisis, some environmental crisis. It could be the housing crisis. It could be, a pandemic, right? It could be a bank crisis. The short-term rates, people are going to stop buying the short-term bonds. They're going to stop doing that because they want their cash. They're going to panic. They're going to want their cash in something safer, in dollars, right? Or, that's just the way I see it. They're going to stop buying short-term bonds. So think about why this would happen. The way I think of it, and this might be wrong here, but the way I think of it is that makes sense to me, is that in the short term, things are going to be bad, and they're expecting things to be bad. And so you're going to have an increasing amount of people that will stop buying these short-term 3 months, 1 year, 2-year bonds, and the 10-year bonds and 20, 30-year bonds. Not many people are going to sell them. So not as much people are going to sell them. And so the big pockets are just moving money around. The way you can think of this yield curve working out is whenever we get below the 0%, that's when investors are selling the long-term yields. They're selling the long-term bonds, or they're not buying them as much anymore, whichever one. And so more money goes into the short term, or no money at all. But there's enough people selling the long term. So the way you can think of this inverted yield curve working out, how it happens, and why when it reverts everything sort of hits the fan, is when you have the 10-year at a certain percentage rate and everyone starts to sell that 10-year, right? The interest rate, what happens to it? It goes up. Alright, so the way you can think about the inverted yield curve I'm going to try and put it as simply as I can put it. But whenever these yields, the inversion goes beneath 0% into negative territory, that means that usually investors are looking at maybe the stock market, maybe they're into commodities, whatever they're in, they start to think it's high risk, like a market crash is going to occur. And so they'll transition their money from these bonds into these other markets. So the way you can think of this yield curve is very simple, and it kind of puts a big spotlight on how the market really works, that there are people that know things ahead of time, for sure, because if you look at what's happening here, the shorter term bonds have a higher yield. What does that mean? That more people are selling the short term bonds. The long term bonds also usually see higher yields because more people are selling them, but because they're longer term, some people hold on to them, and so they usually could be either stable or they could decline. But the shorter term bonds expire faster, so they're being sold more, or not bought again. So there's a decline in the yields and there's a raise in the prices for short term. So the way you can think of the yield curve is very simple, but one thing is for sure, that this is proof that there are people that know things ahead of time that can position themselves in these markets with insider information that me and you, the public, may not know. So again, this is the 10-year and the 3-month. And so what this negative yield is that the 3-month has a higher yield than the 10-year. So think about how that would happen. That would mean that if the yields are higher in the short term, more people are selling that 3-month yield, and they don't want the 3-month yield, and more money would be moving into the 10-year, the longer term yields, or the 20-year or the 30-year. And so when more money is moving from the short term to the long term, you're usually going to see the long term price go up, yields go down. And so then the short term, no one wants it. The long term, everyone wants it. That tells you that in short term, investors are expecting bad prices, market crashes. And in the long term, they think it's safer, because in the long term, they're going to get more for their money than if they stayed in the stock market or in the commodity market or whatever other market they're in. Right? Now you can understand how there's this game here is very cyclical. Right? There's market cycles that occur. We have expansions every 8 to 10 years around, and then we have recessions or crises. Okay, so we had the Gulf War in 1990, the 2001 dot-com burst. Within 10 years, we had the 2007 market crisis, and in a bit over 10 years, we had the 2020 COVID, and now we're having, not too much longer, we have the whatever is going to happen next, maybe 5-8 years. Again, every 6 to 10 years, around 8 years, you have a recession. Like, you need to have one, right? Like, I know housing market, COVID, we didn't have one, but we just came off of a huge crisis. The 2007 market crisis was huge, and this is how the economy continues to grow. It needs to have recessions, and I can go into that in another video. But this is proof right here that people can read these cycles, these market cycles, and can position themselves ahead of time. This is proof that they position themselves ahead of time by the longer term bonds being bought over the short term bonds. So money's moved out of the stock market or whatever into these long term bonds, to the 10-year, and they're moved out of the 3-month bonds, the short term bonds, into the 10-year. And so no one's holding on to short term things, and they're looking for a safe haven, which would be the US bonds of the longer term, to put their money in. And that's what occurs. And this right here is proof of that. So that's all for this video. I hope it was very insightful. Let me know if you liked it, and thank you very much.